Good evening and welcome to this special show on hybrid funds and asset allocation by DSP Mutual Funds. Most of us understand this. Eating whatever is not enough. A balanced diet for your body is what you need to make that healthy difference. Similarly, when it comes to planning your life goals, a sensible investment plan with a good mix of different asset classes like equities and debt designed to fit your specific need is what you should aim for. Experts say hybrid funds offer you the stability of debt and aggression of equity funds. Can hybrid funds be a meaningful choice to help investors to balance the risk reward ratio? Can investors get exposure to multiple asset classes through this single fund? Let's know more about the importance of asset allocation and hybrid investing from a very special guest for today, Mr. Abhenav Khettry, founder and director, Vyana Wealth. Abhinav is an alumnus of the Doon School, Dehradun, and St. Xavier's College, Calcutta. Being an entrepreneur by nature, Abhinav became an independent financial advisor at an age of 19. After his successful stints across different asset management and wealth management firms, he set up Vyana Wealth in 2007. Abhinav, I should say, is a multifaceted personality, not just a wealth manager. He's also an avid sports person with his interest in cricket, golf, and dart. He's also an author. Abhinav's views and opinions have appeared in several media like the Wealth Forum, Cafe Mutual, Business Standard, Economic Times, and many more. Abhinav, I welcome you to the show. Thanks for joining us today.
Thank you so much, Sumana, for this opportunity, and thank you, DSP.
So before we start the conversation, request all viewers to share questions if you all have in the chat box, and we shall take it up towards the end. So Abhinav, let's begin the conversation. We would want to know more about you and Vyana. Can you talk about your journey and Vyana's as well?
Sure. I think, like you mentioned, I started off at a very young age. In Calcutta, we have the option to work along with college because college gets over at 9:30 in the morning. So I didn't want to waste any time and just chilling with friends. I wanted to do something productive. And this is the era of what 2004, 2005, and the capital markets in India were just developing in the second phase, you can say. And that was the era where FI flows were tremendous, and the Sensex was making new highs every day. So I remember that was the time when Sensex hit 5,000 for the first time, then 6,000 and 7,000 for the first time. So as youngsters, these were very exciting times, like how kids are pulled to crypto today. That time we were pulled to investing in stocks that time. And my family is in the auto component manufacturing business. And I was basically helping out managing the surplus cash of the family. And that's how I actually got interested in this entire and realized that it's a beautiful business to be in. You help so many people, and it's also it's a very entrepreneurial as well as social work. You can give back to society in so many ways by creating wealth for families and by helping people on the right financial path. Helping youngsters instead of blowing up money, you can actually help them to save and invest and judiciously manage their finances. So it's there's a lot of social work. There's a lot of the elements are multifaceted here. And that's what attracted me to the industry, and I kind of never looked back after that. So I just kept on going in that direction.
So from auto components to personal finance, that's quite a fascinating story. So how large is Vyana Wealth now? And if you can also tell us what kind of investor profile does your team manages?
Sure. So the auto component business was never mine. That was the family business. I was never part of that. And I've only done financial services in my entire life. And today we are advising over 3,200 investors. That's the total Vyana family. And the total assets under management across mutual funds, bonds, and portfolio management services are about 400 crores. And we have a SIP book of about 1,700 live SIPs with about 1.4 crores of throughput every month. And the basic profile is that, first of all, obviously, we don't like to say no to anyone. We like to start because, of course, when I started off, I was very young and very difficult to win trust of people at that age. So I have my smallest of clients have today become my largest of clients. So we don't really have a say no policy. We don't say that, oh, if you're not worth a crore, I don't want to talk to you. That's not the kind of a culture I've built in my company. We like to welcome everyone who's looking for financial inclusion, or you can say any like want to walk down the correct financial path. And we realized that the smallest investors, within a few years, they become really, really big, given the right path, the right direction, the right motivation. I think a very, very big part of what financial advisors do is motivating you to save and invest more and do it in the correct way. I always give this comparison that financial advisors like us are very similar to gym trainers. You can go and sign up for a gym, you can get the membership, but to actually go there and work out, you need someone to be there, motivate you, help you, tell you the right way to do things, and not hurt yourself, not injure yourself. That's also a part of what we do. Managing your diet, managing so many other things about your body, because every human being, every body is different. Similarly, every person's financial plan is different. So we do the role of what a gym trainer does for you, and we try to help you in every way possible like that. So yeah, so we don't really have a say no attitude. We want to get every family, every person on board. Obviously, we have some very, very large institutional clients. We have some very large corporates and trusts who invest through us. We have some family offices outside of Calcutta also who invest through us. But we also manage the portfolios of the employees of these clients of ours. So we include everybody in our journey.
Great. So you seem to manage a variety of client portfolios. So is there a specific process that you all follow in order to build good portfolios, or how do you suggest funds for clients?
I think the portfolio building process is a lot to do with the conversation you have with the human being. Calling him a client or a friend or anything, but end of the day, he's a human being. So what we try to do is we understand the human psyche behind him. The first thing we try to figure out is that what is his expectation. He'll never say it, he'll never spell it out, but in our conversations we try to gather that, we try to understand that what is his expectation from us. What is his risk appetite? How much of volatility can he sustain? Is he a person who is only there for the good times and will shy away the moment things are not going in as per his expectations? So, frankly speaking, it's a lot to do with counseling at the before we sign him up, before we do his KYC or before we take his first check. It's a lot of counseling. We want to actually tell the client upfront that there is risk, there is volatility, there is chances of losing money. But we also at the same time motivate him that if you don't invest, what are the pitfalls of not invest? What we like to do is that educate him as much that when he comes on board with us, he is also able to take decisions. So we are only basically hand-holding him after a point, but most of the decisions are taken by him. So the process is such that in selecting funds or building portfolios is that based on how much of a risk appetite he has, then we select funds from which we feel will be adequately suited for him, which will sustain his risk appetite, which will sustain his return expectations. Because it's very easy to do a transaction. It's very difficult to manage a relationship. Okay.
Absolutely.
So the moment you do a one-off transaction, which may not be favorable for the investor, you are moving away from him being your friend to him being a disgruntled investor. We don't want that. For us, we are a small firm, so for us, the word of mouth or the personal recommendations are our biggest asset. So we always want our clients to come back to us and to recommend their friends and family members to invest through us. So the process to spell it out is very human driven. It is very intangible in the sense that if every investor is different, what we also do is we also try to study the fund managers. Now, what do I mean by this? We also try to have in our conversations with fund managers, often we understand what kind of risk takers are they. There are various situations where you can ask a fund manager his hobbies. If a fund manager says that driving race cars is my hobby, he's obviously a very aggressive person by nature. If someone says I love doing yoga, okay, he is a very different person by nature. So these are small traits that we also try to pick up from our conversations with fund managers and try to bucket fund managers also in different categories as aggressive, moderate, or conservative. It's not just the asset allocation of the fund, it's also the understanding of the fund manager as a human being. So what I'm basically doing is I'm connecting one human being to another and figuring out that which one will suit whose risk appetite and portfolio management style.
That's quite an interesting process, and you highlighted that you value a lot on risk profiling, and you also go that extra bit to check how even the fund managers are behaving and how they are going to be probably managing a fund. We are going to listen more from you, but before that, to all the viewers, if you are enjoying our content, do share your likes and comments. And if there are any questions, do put that in the chat box. So coming back to you, Abhinav, you did mention about risk profiling in your process. And there is a lot of talk of risk profiling and asset allocation as key pillars to building long-term wealth. So what exactly, if you tell our viewers, what exactly do you mean by asset allocation, and how do you differ it from diversification? How does it differs from diversification?
See, first of all, diversification is referring to different, different stocks or different bonds within the same asset class. Okay, so like if I have an equity fund and I'm investing across banking sector, pharma sector, auto sector, so that is diversification in a stock portfolio. Similarly, if I have a debt portfolio, I'm investing some in government bonds, some in corporate bonds, some in bank bonds. That is diversification again within the a particular type of fund or a particular asset class of fund. But asset allocation is referring to dividing money or allocating money to different asset classes. So the asset classes that we usually refer to are debt and equity. And the third or fourth asset class which can be taken into account is an arbitrage position and gold via the gold ETFs. So hybrid funds in India would have either debt and equity or debt and equity and arbitrage, or all four: debt, equity, arbitrage, and gold. And now also SEBI is permitted silver. So some of the multi-asset or what we call hybrid funds have also permitted to invest in silver and gold ETFs. So that is the difference between asset allocation and diversification is that I would choose more than one asset class in a hybrid fund, which will be called asset allocation. And I would move between these different asset classes based on the market scenario or between evolving situations. Whereas diversification will refer to a particular asset class being diversified across sectors.
So it doesn't seem then the asset allocation could be a one-time activity, does it? Or does it changes with time? And what are the typical triggers that leads to changes in asset allocation, if you can tell us?
See, asset allocation is based on various human traits again. Like I was mentioning that we understand and study our clients very intricately. So every individual's asset allocation will depend on his requirements. So if he is having a very high expectation of returns and he can tolerate volatility, so his asset allocation will be a very aggressive one, which will have more allocation to equities. Similarly, a conservative one would, or a moderate one would have a lesser allocation to equities, and probably a higher one to debt and arbitrage positions. So this would reduce the volatility in their portfolios and provide them maybe very similar returns. So I'll give you a small example. If you look at last 5-year returns of large cap funds and say balanced advantage funds as a category, you would see that the returns are almost very similar, but the volatility is much lower in balanced advantage funds. So the advantage here is that you are able to generate the same amount of return at a lower degree of risk. So to answer your question, we need to figure out that what exactly is the requirement of the client, what exactly is the need and his risk appetite. If he feels that, okay, I've invested 10 lakh rupees, but tomorrow it becomes 9.5 lakhs, how will he react? Will he exit his investment? Will he try to take a step which may be detrimental to his own portfolio? So it's where the human element, the psychological element, or the hand-holding part is very, very important in managing investments.
So from an investor's point of view, then how often should they look at modifying their asset allocation?
So these could involve any major life goal changes. These could involve any change in terms of their overall financial plan or situation. So for example, if a person had saved up money for say his child's education, or I'll just giving an example. Suppose somebody has saved up money for his daughter's education abroad, which would have cost him over 1 crore, And what he did was, by the time she turned 16 or 17, he moved the entire money into debt because the impending outflow would have been very, very near. So he did not want to take his risks or his bets on equity. What he's done is basically moved from equity to debt to make those payments. Now suddenly he realizes that his daughter's got a full scholarship and he doesn't need that money to be paid anymore. Now he can go back into equity because the horizon again has changed. So based on situations, based on scenarios, based on requirements. Now again, another situation could be like say a retirement scenario, where a person at say 55 was supposed to retire as per the company policy, and he at 54 moved his entire portfolio to debt. But suddenly at 655, his company says, okay, we're giving you an extension for 5 years and you don't need to retire. So his profile has changed now for the next 5 years. He will have a steady income and he will continue to accumulate money in the next 5 years. And his post-retirement life has been postponed by 5 years. So in the evolving scenario, the risk, the asset allocation can again be revised to a more aggressive situation. So there are many such scenarios. Many times clients get windfalls of certain payments, and their needs can be met with that one-time income rather than the current portfolio. So you can change as per the requirements.
Right. Abhenav, you did mention a lot about hybrid funds in the examples that you gave. Could you also elaborate how hybrid funds work and what are the different categories of hybrid funds?
Sure. So as per the SEBI regulations, hybrid funds are primarily of 4 types. A hybrid fund is anything which has more than one asset class. So there were actually hybrid funds which had debt and gold. Okay, so those were also hybrid funds. They did not have any equity, they did not have any arbitrage. That's also a hybrid fund. But the typical classification as per SEBI, so what we have at the lowest end is what we call the MIPs, which would have 15-20% of equity and rest 80% to 85% in debt. The category after that are called equity savings, which would have again 15, 20, 25% in equities, another 40% in arbitrage, and the balance 35% in debt. This was basically done to have equity taxation with low volatility and slightly better returns than debt. Then we have the stagnant asset allocation or what we call the aggressive hybrid funds, which would have a 65-35 or a 70-30 equity debt allocation. These would again be taxed like equity funds, and but these would be static in nature, so they would have a constant asset allocation, not change very often. At the most, they would do some profit booking and realign back to their earlier allocation. But the most dynamic one, and according to me, the best one in the industry, are what we call balanced advantage funds or dynamic asset allocation funds, which, based on various market scenarios and market situations, like price to earning ratios becoming, or valuations becoming very expensive, or price to book valuations becoming very expensive, or momentum changing due to certain government policies or various other situations where the market momentum changes into a different direction altogether, can very, very quickly change the allocation between debt and equity to suit and serve the investor's interest. Also, it has a very robust profit booking, or you can say realignment back to to its earlier situation, to its earlier allocation. So dynamically managed asset allocations again have various strategies, but all in all, they are very, very good investment options for first-time investors, for retired investors, for anyone who wants more than the fixed income returns, but at a much lower volatility than equities. Now, why do I keep mentioning this term volatility? The SEBI disclaimer on mutual funds is that mutual funds investment subject to market risks. Please read the offer document carefully. I would, if given an opportunity, would recommend to SEBI that they should change the disclaimer to mutual investors subject to volatility. That means the price of your investment can change. It can become higher or lower. But risk, kind of confuses investors because the risk is basically becoming 0 or 100, So I think more than risk, mutual funds and, equity markets subject to volatility. And this volatility is what scares investors. And balanced advantage funds and hybrid funds in general try to reduce the scariness, try to reduce the volatility, and try to give a much smoother experience to the investors. So these are the 4 kinds of hybrid funds which are there.
Understood. So Abhenav, you mentioned that hybrid funds could be suitable for beginners as well as for people who are experienced investors also. What should be the ideal investment horizon to look at when someone looks at investing in hybrid funds?
I think from 3 years to infinity, because till the time you don't need the money, you can very much stay invested. So we have lots of investors who have put in the retirement corpuses into dynamic asset allocation funds, balance advantage funds, and have started SWPs on those amounts. And that has been going on now for 6, 7 years, and I see them going on for the next many years till the time they don't need the money. I think it's a great retirement tool to ensure regular cash flow, less taxation, and a very hassle-free investment experience compared to either a fixed deposit or a pure equity strategy. And I think there is no upper limit on how long you can stay invested in a hybrid fund, but I think the lower limit should be at least 3 years.
Great. So you did mention about the benefits of investing in hybrid funds in short. Are there any disadvantages that investors should be aware of when they are investing in hybrid funds?
Obviously, they won't give you returns as high as pure equity funds in the long term. Obviously, that is a tactical call that you're taking, that you're sacrificing a bit of return for reducing the volatility in your portfolio. So please never compare the returns of hybrid funds with equity funds. And similarly, do not compare the returns or the volatility of a hybrid fund with a debt fund, because debt funds will obviously have a much lower volatility than even a hybrid fund. I'm not saying hybrid funds don't have volatility, but it'll be more than a debt fund and less than an equity fund. So do not do that. Another misnomer which is there, especially I've seen that a lot with the youngsters, especially who follow social media, pundits, is that index funds have very less risk. So index funds invest in index funds. I mean, I don't know where this concept started from, but index funds are normally equity funds, and they would also have very high volatility. So a balance advantage fund or a regular hybrid fund is basically in between a debt and an equity fund. Obviously, you are sacrificing returns for lower volatility.
Great. You did mention that one of the best hybrid fund category to look at is dynamic asset allocation funds. Could you elaborate a little more on these funds? How do they work? And in the industry, we find a lot of DAAFs or dynamic asset allocation funds. Are all of them similar? What should an investor expect from these kind of funds?
Sure. So, see, dynamic asset allocation funds, first of all, I would really like to compliment the industry for creating this product. Why do I say this? Today, if you have an equity portfolio, of any mutual fund, it can be easily replicated by an investor. He can start buying the same stocks in the same ratio, then he can hold it. Obviously, he will not know when the fund manager is buying more or selling of those positions, but he can more or less replicate that portfolio. It is impossible for any individual investor to replicate the workings of a dynamic asset allocation fund or a balance advantage fund, simply because these are run on various mathematical models or various proprietary models, which are obviously, like I said, proprietary. So they are the backend is obviously well known to the fund managers or to the research team or or to the trading team, which is able to execute that. Now, what do I mean by this? There are various fund managers and there are various different dynamic asset allocation strategies. Like, for example, some follow a strategy where the valuation methodology is used. So that means that if the price to earning ratio of the Nifty is crossing a certain level, they would reduce the equity allocation. And similarly, the reverse would happen in case the markets are becoming cheaper. They would increase the equity allocation. Now, this is, I would say, a strategy which was probably relevant 10 years back. Today, what has happened is that things are more and more dynamic. Things are not as simple as they used to be. Markets may be expensive or cheap due to a variety of reasons. So a lot of fund managers are not taking into account momentum. So momentum is basically referring to which particular stocks or which particular sectors are in favor at this point of time. Another set of fund managers also take into account flows, or so equity flows and debt flows, and how that is, how that is trending in the last 2 months, 3 months. And another measure of momentum is measuring indexed to the DMA, or the 200 daily moving average, or the 100 daily moving average. So there are various mechanisms that fund managers use to decipher what would be the debt allocation and the equity allocation for the next 15 days or for the next 30 days. And obviously, whenever earning season comes, these valuations also keep changing. And based on that, the allocation can also keep changing. Also, you have times when individual stocks or sectors run up too much. But balance advantage fund managers will not be very, very long on certain stocks. They could trim their positions, they would book their profits and bring it down into a debt holding. There are various situations, there are various scenarios. So it's not a fill it, shut it, forget it thing from the fund manager style, but it is definitely for an investor. You can fill it, shut it, and forget it for an investor, but at the back end is rather complicated, and the fund managers are doing a fantastic job by being able to deliver almost large cap fund like returns at much low quality.
Great. So it seems that if someone's a busy investor and really does not have too much of time to look at a portfolio on a regular basis, he or she can really rely on dynamic asset allocation funds, right? You also mentioned about another category of these funds, which is equity savings fund. What exactly is an equity savings fund? Who can invest, and what should we expect from these funds?
So equity savings as a category is designed for the equities. Sorry, I think we just had a little tech problem. Equity savings fund as a category is designed for investors who want slightly more than debt returns at but at even lesser volatility than a balance advantage fund. So equity savings would typically have between 15 to 20% in equity.
Guess we are experiencing a little bit of tech issues here. Abhinav,
Yeah, can I go ahead?
Yes, please.
Yeah, sorry, I think it's echoing a bit.
Abhinav, you can go ahead.
So equity savings funds are basically between 15 to 20% in equity and have even lower volatility than balance advantage funds, and are designed for investors who require returns slightly more than that.
So guys, we're taking a little break here. To all our viewers, if you are enjoying our content, do share your likes and comments. And if you all have questions in your mind, do share that as well in the chat box, and we shall take up your questions soon. So Abhinav, we would also want to know, when we invest in hybrid funds, what kind of taxation should we expect from our investments?
So hybrid funds are usually taxed like equity funds. So the equity savings fund, the aggressive hybrid equity, as well as the balance advantage category, all three are taxed like equity funds.
Okay, great. What percentage of one's portfolio should be in hybrid funds, or is there a specific asset allocation criteria that we need to follow for hybrid funds?
I would believe that hybrid funds should be the core of an investor's portfolio, be it a young investor or a senior investor. Because eventually we as Indians want to beat FD returns with less tax and less volatility of equity markets. So these are perfectly designed
So Abhinav, you can continue speaking. We cannot hear the echo. Probably there's some issue in the tech thing, but we can hear you clearly. So you can continue speaking. Abhinav, can you hear me?
I'm so sorry. It was echoing at my end. So
no problem. You can continue. Yeah, we can't hear the echo.
Yeah. So just repeat your question once.
Yeah. So I said, what percentage of one's portfolio should be in hybrid funds?
Yeah. So hybrid funds would typically have about 40 to 50% of your allocation should be in hybrid funds. Even if you're a young investor or an elder investor, this is actually the right way to start your portfolio, to build your portfolio. And the hybrid funds should primarily, your entire rest of the portfolio should be around the hybrid funds. Hybrid funds in the center, and your aggressive funds and your funds should be around that.
Great. Abhinav, when it comes to pensioners or people who are about to retire or who are in the age of 60s and 70s, what kind of funds do you recommend to these category of investors?
So equity savings funds, balance advantage funds, these would be ideal for them. When we invest in these funds, then we can actually start SWPs from them. SWP stands for systematic withdrawal plans, and the investors can get the benefit of regular cash flow, absolutely credited bank on the beginning of the month, which will sustain their lifestyle, and their portfolio can also grow over a period depending on how much they're withdrawing and how much the fund is actually growing. So, but SWP is an ideal option from equity savings funds and balance advantage.
Great. Any last word of advice that you would want to give to our young social media viewers on, how they should be investing their money?
So the trends have for the young investors have been very much towards passive investing and index fund investing, and we've been hearing a lot of these gurus, online gurus, who've been talking about how passive investing is better than active fund management. What they don't realize is that we've had 10 years or maybe 15 years of easy liquidity after the global financial crisis of 2008. Governments have pumped in money, and this money capital is very easily available. In that situation, the money has gone to almost every stock in the index, or the availability of capital has been very easy. So what happens is, or rather, what has happened is that index investing has become very lucrative, or it's become very simple. But I would say that with tightening global liquidity, rising inflation, individual stocks, picking individual stocks will become a key going forward. And it's not, the index is not going to outperform anymore. You will see that various sectors or various standalone companies will actually be able to outperform the index by large margins. So please do not only fall for index investing, also with managed funds, and also so index investing is not the way out, and also look at active fund management, and also look at hybrid funds in the long term.
Great. Abhinav, thanks so much for joining us today and sharing your valuable insights on hybrid funds, the category of hybrid funds, and what are the things that we need to keep in mind when we are investing in hybrid funds. To sum it up, you have suggested a couple of points that I have jotted down. You have mentioned that the process that you all follow at Vyana is quite a human-driven process, and you give a lot of importance to risk profiling. And that holds true when you also evaluate fund managers' way of how they manage their funds, and you evaluate fund managers as well. You mentioned that asset allocation differs from person to person, and it depends on the kind of goals that they have, and the time horizon they need to have for their investments. And you also mentioned asset allocation can also be modified going forward if some of the goals of a particular individual investor changes. While you were mentioning hybrid funds, you did mention that DAAF, or Dynamic Asset Allocation category, of fund could be quite a interesting one to look at. And this is particularly suitable for busy investors who really do not have a lot of time to manage individual funds in their portfolio. They can look at investing in DAAF or Dynamic Asset Allocation category. You did mention about the importance of index funds, and also that index funds can also have volatility in their performance. Abhenav, do mention if I have missed out on any of the important takeaways that you had just highlighted. Great. So, okay. So I'm assuming I'm a good listener then, for sure. I do have a lot of questions that has come for you, Abhenav. So I will take a few questions for you. Just allow me a moment. So the first question is from Shreya Swagmare. How much percentage out of 100 should one invest in hybrid funds?
It depends on his current age. It depends on his risk profile. What is he looking for? Also, I don't have enough information to give an exact answer. But when I start building portfolio, I try to put about 40-50% into hybrid funds to start with.
Great. The next question is from Neha, and she wants to know what is the difference between hybrid funds and multi-allocation funds? Are they the same category of funds?
So hybrid funds and multi-asset allocation funds are one and the same thing. The only difference is that in multi-asset allocation funds, you also have the element of gold and silver, which is not there in other regular hybrid funds.
Great. The next question is from Manohar. He wants to know, can you please share the past performance of hybrid funds? So if you can tell us in brief, what is the kind of returns one can expect from hybrid funds? I think this would vary from category to category, right?
So hybrid funds would typically give you returns slightly more than fixed income and lesser than equity, because that is the nature of the product. It is designed in that way. So it all depends. Year-to-year returns will depend on how these two assets also are performing. Can't give you an exact number answer.
Okay. The next question is from Pallavi. Abhenav mentioned several categories of hybrid funds. How can one choose which one suits for themselves? Say for a 30-year-old, what category can he or she go with?
The easiest is balance advantage fund. Start with that. See what your experience is like. And if you want a higher return, then you can go with an aggressive hybrid fund. And if you are comfortable with a lower return with lower volatility, you can move back down to an equity savings.
All right. The next question is from Benaz. What's the difference between hybrid and balanced funds?
No, there is no difference. This is a SEBI classification, and balanced funds and hybrid funds are one and the same.
Okay. I have another question from Kaustav. He wants to know what are arbitrage funds and how can one use arbitrage funds in their portfolio? Are these also a category of hybrid funds?
Well, technically, yes. Hybrid funds are also, arbitrage funds are also a category of hybrid funds. Hybrid funds would probably, arbitrage funds would be at the lowest risk element, have the lowest degree of risk. Obviously, the consumer returns will also be much lower. Arbitrage funds are basically taking advantage of various arbitrage positions market between the cash market and the futures market. And they are hedging their positions and basically making money on the spread between these two prices of the same stock or the index. The risk element here is much, much lower compared to any of the other hybrid funds. And yes, the returns will also be what the spreads are the cash futures market. So the returns last 1 year or so have been around 4-5%. And historically, the returns have been more in line with what a liquid fund is delivered. So arbitrage funds with liquid fund returns with taxation.
Okay. My last question is from Rashmi. Are index funds direct options? They have very little expense ratio. Index funds too have given approx 15 to 18% return when we remain invested over a longer period. So is it a good option to look at? Because they have
Yes. So
less
index
expense
funds,
ratios.
like I said earlier, also index funds have given returns in the past, and they have actually given very good returns in the past. But going forward, index investing will not be the same as what you've experienced in the last 5-10 years. The entire scenario around index investing is going to change, and you will find that tremendous value in being able to select a good fund manager will be there. Past performance, expense ratios, these are no factors of future returns. So you can allocate to an index fund as you wish, but also to look at investing with good fund managers. They will be able to generate you better returns in the future.
Sure. Abhinav, thanks, for answering all the questions that our guests have. Guys, if you need any more help selecting hybrid funds, DM us on Instagram or leave a comment on the YouTube stream, and we will connect with you ASAP. We all understood from Abhinav how important it is to follow the asset allocation strategy. But I guess the first step towards asset allocation should be to evaluate your own risk appetite and risk score. We highly recommend that you visit dspim.com and use the personalized recommendation tool called Sakti. It is a complimentary tool that is available for everyone, whether you are an existing investor or not. And it will just take you 5 minutes to evaluate yourself, know yourself better, and also your risk appetite before you start investing. I'm sharing the link in the bio for the Instagram and also in the YouTube description for your reference. Hope you take out some time, use it, and check it out. Have a good evening and happy investing. Thanks once again, Abhinav, for joining us.
Thank you so much for the opportunity. Thank you, DSP.
Fund investments are subject to market risks. Read all scheme-related documents carefully.